Hello, everyone. Just going to do a quick sound test. If you can hear me, please type yes in the chat box on the toolbar. Yes in the chat box on the toolbar. Thank you. Today's webinar. This will be a tax reform update for the real estate industry. Today's program will be presented by Ian Taylor, Senior Manager, and Sarah Poldick, Manager at Witham Smith & Brown. Before we begin, I have a few notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. Also, at the bottom of the toolbar, you will see a chat box. Feel free to send us your questions during the presentation. We will do our best to address them. There will be 6 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Ian and Sarah.
Thanks very much, Jess. Welcome, everyone, and thanks for joining us. As Jessica said, I'm Ian Taylor, and my co-presenter is Sarah Poldick. Both of us are members of Witham's Real Estate Industry Group. Right around this time last year, we were all wondering what would come of the tax bills proposed by the House and Senate. Since passing the final act on December 22nd, 2017, the Treasury and IRS have been busy interpreting the law and providing taxpayers with additional guidance. In this webinar, Sarah and I will cover the basics of 5 key areas of the new tax law and discussing the updates that have been provided over the past 12 months. The key areas we'll be talking about, we kind of divided up between potentially positive and potentially negative areas. So positive areas being depreciation, including Section 179 and bonus depreciation, the 20% qualified business income deduction, and finally, qualified opportunity zones. On the negative side, we'll talk about the business interest expense limitation and the possible election out for real estate businesses, and also the excess business loss limitation and how NOLs work along with that. So without further ado, I'll kick it over to my co-presenter and she'll start talking about depreciation.
So first part of depreciation, as far as changes that we'll talk about, is Section 179. Section 179 is immediate expensing of qualifying property. Under the old law, the expensing limitation was set at $500,000. Under the new law, it's now set at $1 million starting after 12/31/17, and that's indexed for inflation going forward. The phase-out threshold relates to the amount of qualified property purchased by a taxpayer in a given year. Once you hit the phase-out threshold, which is now $2.5 million, it begins a dollar-for-dollar phase-out of the deduction. It's important to note that there are certain limitations to utilizing Section 179 that don't apply to bonus depreciation. You cannot use Section 179 to take you to a loss, whereas bonus depreciation can be used if you have a taxable loss. There are also per-person limitations to Section 179 that do not exist with bonus depreciation. The definition of eligible property under Section 179 has been expanded. Under prior law, eligible property was tangible personal property that is purchased for use in a trade or business and included qualified real property, including qualified leasehold improvement property, restaurant property, and retail improvement property. Under the new law, qualified real property has been expanded to include any of the following improvements to a non-residential real property, such as a roof, HVAC property, fire protection and alarm systems, as well as security systems. This is an important change for the real estate industry, as the above items do not qualify for bonus, as some of them are internal portions of the buildings and to the internal structural framework of the building. Bonus depreciation is an additional first-year depreciation deduction allowed for qualified property. Under the past law, bonus-eligible assets were property with a depreciable life of 20 years or less and not available when you are required to use ADS, the alternative depreciation system. The old law had bonus phasing down at 50% in 2017, 40% in 2018, and with no bonus going forward after 2020. The new law has bonus at 100% from 9/27/17 to 12/31/2022, starting to phase down at 80% in 2023, 60% in 2024, and fully phased down with no bonus going forward after 2027. An important change to bonus depreciation is the ability to bonus a new asset. Under prior law, it was a requirement that the property be new, and now it just needs to be the first use by that taxpayer.
And that's going to be important for mergers and acquisitions, or buying interesting partnerships. You get the additional write-offs, so people are definitely going to want more asset purchases than in prior years.
As of September 27th, 2017, 100% bonus was available on qualified property. In order to claim this 100% bonus, the property needs to be acquired and placed in service after 9/27/17. Buildings are deemed to be acquired as of the date that there is a binding contract for sale. Keep in mind that state law will dictate this date. Self-constructed buildings are acquired when physical work of a significant nature begins. It's also important to keep in mind that if you have work that started pre-9/27/17 on qualified property that's placed in service in 2018, you'll be limited to the 40% bonus under the old law phase-out. Qualified improvement property removed the following requirements: that the improvement be done subject to a lease, that it wasn't done to a property leased by a related party, and it removed the 3-year placed in service requirement. Now property needs to only be in service the day after the building is placed in service. Qualified improvement property took 3 categories of property down to 1. There's one issue. In the drafting of the new law, they made a mistake and left out the section that would make qualified improvement property 15-year property. As of now, without a technical corrections bill, we will have 39-year treatment for qualified improvement property. There's good news there, though. If you intend to elect out of the interest limitation, you won't be impacted as greatly. The give back will be going from 39 years to 40 years for ADS for the qualified improvement property. For 9/28/17 to 12/31/17, we were able to take advantage of bonus depreciation on those qualified properties. But after 12/31, we will no longer be able to take advantage of bonus without a technical corrections bill. However, there is a positive change with the new law regarding bonus, and that's the ability to take it on Section 743 basis adjustments.
And that's specific to 743 as well. A lot of times, you'll hear the term Section 754 election, and related to that are 743 and 734 adjustments. The regulations that came out made it pretty clear that 743, so when you do a cross purchase of an interest, that is eligible for bonus depreciation. But when there's a redemption and a basis adjustment under 734, that's not eligible. So a key difference between those two code sections.
And it's important to remember the tangible property regulations. In September 2013, we received final tangible property regs that greatly impacted the way we treat repairs and capitalized items. It's extremely important that we continue to implement these rules, especially to consider the expensing of items that should be classified as a repair rather than an improvement, and the ability to take a partial asset disposition if you replace a portion of the property that's already capitalized. Keep in mind, with all the depreciation provisions, you do have state conformity issues, and if you get a federal benefit, you may be giving something back on the state level. We're going to switch gears, talk about the business interest expense limitation now. The business interest expense limitation rules are replacing the old earnings stripping rules for interest paid to related persons who do not pay U.S. tax on the corresponding income. The new rules now apply to all businesses and will place a limit on net interest expense deductions. Now, interest expense may only be deducted to the extent that it does not exceed 30% of adjusted taxable income. There is an exception for the small taxpayer. If your average gross receipts are less than $25 million, you will not be included in the limitation. You must keep in mind that there are aggregation rules, so just because you own 10 separate entities that add up to $25 million in receipts, you will be included and not subject to the limitation, Tax shelters are not eligible for the small taxpayer exception. Tax shelters are excluded from the less than 25 million gross receipts test. A tax shelter is defined as any enterprise other than a C Corp that has been registered with any agency to regulate the offering of securities, or any syndicate or tax shelter listed in the listed code section. A syndicate is defined as any partnership or other entity that allocates more than 35% of losses incurred to limited partners. If this is not the case in a given year, they're not considered a tax shelter for that year. Tax shelters can still elect out in a given year, but they will be subject to using ADS depreciation and losing bonus.
And that's still a bit of a somewhat gray area. The law doesn't say specifically yes or no whether a tax shelter can elect out, but it seems the way we interpret it that they still do have the ability to do so. But that's one area where, you know, the IRS and Treasury puts regulations out there and then kind of creates more questions than answers sometimes. And this is one of those areas.
Here's an example on aggregation. X and Y are domestic partnerships under common control. X is in the trade or business of owning and leasing residential real estate, and during 2019, they received of $6 million. During this year, Y has average annual gross receipts of $21 million. Because they're under common control, they must aggregate gross receipts and are considered to have above the $25 million average annual gross receipts limitation, and as a result, they will be subject to the interest limitation. Assuming it meets additional requirements, they may elect out as an accepted real estate trade or business. If you qualify as a real property trade or business, you will be able to elect out of the interest limitation. However, they won't take something for nothing. So if you elect out, you'll be required to use ADS depreciation for non-residential, residential, and qualified improvement property.
And the question here is whether that calculation is prospective, retrospective, or what? You know, when do you have to start calculating ADS? And that's an area where we're really waiting for some guidance, because that's going to have a large effect on real estate taxpayers. You know, if you got to go back and recalculate depreciation, you know, on a 39-year asset or whatever it might be, that's a lot of work to get done. So we're hoping for prospective adjustments, but we'll have to wait to hear from the IRS to make our final, you know, calculations on that.
To calculate this limitation, we need to first calculate adjusted taxable income. Adjusted taxable income is income before income deduction, gain or loss not properly allocable to a trade or business interest expense or income, NOL deductions, depreciation, amortization or depletion, and the QBI deduction. The deduction allowed subject to this limitation cannot exceed the sum of the taxpayer's business interest income for the year, 30% of the taxpayer's adjusted taxable income for the year, plus the taxpayer's floor plan financing interest, specific to the auto industry. Any disallowed interest carries forward as business interest and may be carried forward indefinitely. For partnerships, this is first applied at that level. Excess interest is allocated to the partners and carried forward at the partner level. The partner may deduct the excess interest in future years, but only against excess taxable income attributed to that partner by the partnership in the activities that gave rise to the business interest. Excess taxable income is the amount that bears the same ratio to the partner's adjusted taxable income as excess of 30% of the partner's adjusted taxable income over the amount by which the partnership's business interest exceeds its business interest income.
And here's our first polling question. Do you feel the TCJA will have a positive or negative impact on your business? We're going to give it a few more seconds as the polls are still coming in.
Well, the goal was obviously to be positive, so hopefully most of you guys are answering yes.
We have mixed results here.
Ooh, that's good. So we are in the Northeast here, so chances are, yeah, you might get some benefit of certain provisions, but then that loss of state and local tax deduction or limitation of $10,000 is really hurting a lot of people in this area. So I could see both sides of it.
All right, we're going to go ahead and close the poll. And it was 58% positive, 42% negative.
Okay, yep.
Pretty
So,
split.
yeah, I guess if you're a real estate owner, hopefully with the QBI deduction, which we'll talk about in a little bit, you end up better or at least neutral. And those of us, you know, in the accounting field, or those of us earning W-2 wages, kind of out of luck, and we'll be paying a little extra tax next year, but that's all right. We'll make do. Any case, moving on.
There are a lot of items that need to be allocated and disclosed to the partners now. Each partner's share of gross receipts, adjusted taxable income, business interest income, business interest expense, excess interest income, and excess taxable income, as well as excess interest expense, need to be disclosed. If you have any special allocation to these items, there's a complicated 11-step example in the proposed regs that's 25 pages long, so enjoy that reading.
Yeah, get ready for some really big K1 packages from your tax preparers, because there's going to be a lot of information, as we'll talk about shortly too with QBI, a lot more disclosures that are going to be required on these partnership and S corporation K1s.
Here's an example on excess taxable income. Partnership AB is owned 50-50 by A and B. AB has adjusted taxable income of $200 with no interest income. There's $40 of business interest expense. If you calculate the limitation, AB has a limit of $60 on its interest deduction. Since interest expense is $40, there is an excess interest deduction that's allocated so as excess taxable income to each of the partners of $66.67. In this example, AB is still owned by A and B, but we'll assume that there's $100,000 of adjusted taxable income with $2,500 of interest income and $18,000 of interest expense. In this case, the deduction cannot exceed $32,500, which is the 30% of adjusted taxable income at $30,000 plus the business interest income of $2,500, and for this example, floor plan interest is $0. Since the business interest expense is less than the limitation, it's all deductible at the partnership level. In the next example, we'll assume the same facts with ownership, but their adjusted taxable income is $10,000 with $2,500 in business interest income and $18,000 in interest expense. In this case, the deduction cannot exceed $5,500, which is 30% of the adjusted taxable income at $3,000 plus the interest income of $2,500. In this case, the partnership can deduct $5,500 of interest, and the $12,500 of excess interest would be allocated to A and B and carried forward. Assuming in 2019 now, A and B has adjusted taxable income of $150,000, no business interest income, and $30,000 of interest expense, In this calculation, the deduction can't exceed $45,000. There's no interest income, and 30% of the adjusted taxable income is $45,000. The interest expense is $30,000, so they can deduct all of it. And in this case, they have excess taxable income of $50,000 that will be allocated evenly to A and B. And in this case, in the prior year, they had $12,500 of excess interest. This year, they have excess taxable income, so they'll be able to use some of that interest that carried forward from 2018 with this excess taxable income allocated to them in 19. As mentioned, for electing real property trades or businesses, the interest limitation would not apply. However, if you elect out, you must use ADS depreciation for your non-residential, residential, and qualified improvement property. As a reminder, if you are required to use ADS, those categories are ineligible for bonus depreciation.
Yeah, so when it comes to this definition of real property, trade, or business, the new law refers back to Section 469, and if you guys recall that, that's for real estate professionals. So if you're unsure of how your business falls into these categories, chances are there's some court history regarding real estate professionals that might provide some guidance for you on whether or not your business is a real property trade or business. Because that's one problem with the new law. There's always gray areas that you're not sure about. You know, law is great, but there's only so much of it you can look at when it's brand new. So when there's court cases and history that you can link to, that's the best to provide a clear answer on how to handle something.
Here is a full example on the limitation on interest expense. You'll notice that the net income before interest expense is $1.5 million in both columns, and then we calculate the 30% limit. The actual interest expense is about $1.6 million more than allowed. So in the first column, when we don't elect out, we end up with taxable income of $3.2 million, with that approximately $1.7 of non-deductible interest expense. But if you look at the second column with electing out, we're deducting all of our interest, but we do have a reduction in our depreciation expense calculated here by switching to ADS depreciation. So we end up with taxable income of $1.5 million. So there's a small give back on depreciation, but there's a very large difference in your taxable income. Obviously, these are case-by-case situations that you'll want to determine whether it's whether it's worth it to give up a future bonus. I mean, obviously, in this current law, there is no bonus on the qualified improvement property, so we're just going from 39 years to 40. But any future changes, that would definitely make us weigh this decision a little bit more.
Yeah, and always keep in mind this election is permanent. So earlier when we were talking about tax shelters, yeah, maybe you're considered a tax shelter for 1 year because you're allocating 35% of your loss to a limited partner, but you know next year you're going to be profitable. So you can't just make a decision for 1 year alone. You have to look forward and say what's my scenario going to be 1-2 years down the road, or even longer than that, just to make sure that you don't lock yourself into an election that might not be the best idea in the long term.
And this is a small picture, but you can see there's 3 pages of the Form 8990. This is the limitation on business interest expense form. So 3 pages, it's quite long, but I'm sure you'll want to get familiar with this form, especially if you are above the 25 million and you will be limited. You can see it's kind of small, but this is the draft 3-page 8990.
They're kind of curious how they came out with the draft in October when the regulations came out in November. So definitely I would expect a few changes to this form when the final version is released. All right, so without further ado, we'll keep chugging along here. Our next category is talking about excess business loss limitations as well as NOL limitations. So over the years, there have been several code sections issued to prevent taxpayers from deducting losses. In my mind, the basis and at-risk rules make pretty much logical sense because you shouldn't be able to deduct a loss in excess of your skin in the game, your contribution, and your portion of loans if you're a partnership. That makes sense. However, the passive loss rules were set up to prevent taxpayers from abusing the tax law and trying to shelter ordinary income using loss activities that, with the case of real estate property, usually the activity creates a loss in the current year with depreciation, but over time the property appreciates in value. So Congress wanted to kind of curb what they view as an abuse and put in the passive loss rules. Now with this new tax law, we have Section 461L, or the excess business loss limitation, which in my mind is somewhat aimed at real estate, but not necessarily. I think it's going to affect a lot of taxpayers, and when it does, it's going to hurt bad. We'll show that in some of these examples that we're going to talk about in a few minutes. But this slide, shows a really good visual that I think in the ordering rules of how limitations apply. Basis rules come first, then at risk, then the passive loss rules, and finally the excess business loss limitation. So what is excess business loss? Well, it applies to non-corporate taxpayers, and the excess business loss cannot be deducted. The amount of the excess business loss is treated as an NOL in the following years, which, as we'll talk about shortly as well, and the NOL rules changed, and now NOLs are limited to 80% of taxable income instead of 100% under the old rules. So the excess business loss is the aggregate of the deductions from trade or business over the sum of aggregate gross income and gains from a business plus a threshold amount of either $250,000 or $500,000. That's a really wordy way of saying you're allowed a loss of $250,000 or a loss of $500,000. The IRS released a draft form of this as well, Form 461. Very coincidental how the code section is 461, and so is the tax form. At least it makes it easier for us. And on that draft, they included wages as business income, which was an area that was a little unclear before it came out, and still is a bit unclear for this reason. For the past 2 decades or so, in certain instances, being an employee is considered a trade or business. The question that we have is whether that wage has to be paid by a business where you're taking a loss. So can I have my W-2 from Witham and a loss in a real estate activity and offset them, or does my wage have to come from that real estate activity? That's where the uncertainty still lies, and we'll have to wait for the guidance from the IRS. This is, the excess business loss is probably the one section we haven't got regulations on yet that we could really use some. Like a lot of the more individual income tax type rules in the new law, it only applies for a brief period in time from tax years beginning after 2017 and beginning before 2026. It's also good to note that the $200,000 and $500,000 thresholds are indexed for inflation starting in 2019. And once again, these loss limitations are applied at the partner or shareholder level, not at the entity level. So a super high level example, taxpayer files a joint tax return and has the following items: $650,000 of investment income and an $800,000 loss from a real estate partnership. How do we calculate AGI? Pretty simple. If we look at the excess business loss, if the aggregate of our trade or business deductions, $800,000, over the sum of aggregate business income, 0, and our threshold amount. For married filing joint couple, it's $500,000. So we're only allowed $500,000 of loss. The excess of $300,000 is carried forward. So our AGI for the year is our $650,000 of investment income, less our trade or business loss allowed, $500,000, gets us to an AGI of 150. Now, let's crank up these numbers a little bit to show when it can really hurt. So assume an investment income of $1.5 million and a loss from a business of $6 million. And let's compare the 2017 versus 18 tax law. So in 17, there is no excess business loss limitation. Let's assume this taxpayer lives in a high tax jurisdiction, so they've got a lot of state income tax, mortgage interest, whatever it might be. So they're taking standard or itemized deductions of $700,000. So overall, they've got a pretty large tax loss for the year, and there's no tax to be paid. Additionally, they can try to carry back that loss to prior years as net operating loss. But now going forward, starting with the 2018 law, that $6 million business loss is limited to $500,000. So we have our 1.5 of investment income, $500,000 of business loss that's allowed. If most of those itemized deductions came from state income taxes, that's limited to $10,000, and this person might be taking a standard deduction of $24,000 instead. So we'll assume that brings us to a taxable income of $976,000. So even though this person's incurred a huge loss of $6 million, they've still got taxable income on their return, and following the marginal rates, they've got a $264,000 tax liability, or a 27% effective rate, which is just incredible. All the person did, switching from one year to the next, a $264,000 increase in their tax.
This is going to hurt a lot of our real estate clients. You know, if you have a year with a big deduction, a big loss, you maybe do a cost seg study, limiting that loss to $500,000, and then with the loss of the state tax deduction, it's really going to impact a lot of clients that were not paying federal tax before.
Yeah, absolutely. So as I mentioned, the NOL, or net operating loss rules, are also changing. Under the old law, the NOL could offset 100% of taxable income with certain limitations. You could carry back the loss 2 years unless you elected to forgo it, and there's a 20-year carry forward period. Now, under new law, there's some benefits and detriments. The NOL is limited to 80% of taxable income for NOLs generated after 12/31/2017. Our interpretation of that is that if you have an NOL generated pre-2018, that'll still be 100% offsettable. Is the word offsettable? We'll assume it is, against taxable income. So that means your accountant or yourself is going to have to track separately the NOLs for pre-18 and post-17. Carrybacks are no longer allowed. So in the previous example, I said, you know, the 2017 taxpayer might try to carry back some of that net loss to get a refund. That's no longer possible. You can only carry them forward. The benefit there is that the carry forward period is indefinite as opposed to only 20 years. So as I stated, we got to separately track NOLs from pre and post tax law. One item we have not heard from the IRS on yet is, I'll call it NOL stacking. You know, the ordering rules of when you use your NOLs. Do you use the pre-18 NOLs first, or the post first, or a combination, or whatever it might be? We're still waiting some guidance on that. So another example, continuing it, I think the better way to view it is this chart here. So let's assume in year one, or 2016, we've got investment income of $700,000. In the second year, 2017, we got investment income of $750,000, and we have a loss from business of $800,000 in 16 and $650,000 in 17. So we'll take this fact pattern from 2016, 2017, and also apply the new law as if it was 2018 and 19. So a quick analysis of the facts under the old law. In 16, the entire investment income will be offset by the business loss, and the taxpayer will have a NOL carry forward of $100,000. In 2017, when you combine the investment income of $750, reduce it by the business loss of $650. We still have that carryover, the prior NOL, so taxpayers no taxable income in either year. Now, if we took those same facts and apply it to 18 and 19, in 2018, our business loss is limited to $500,000, assuming married taxpayer. So when we take our $700,000 investment income and reduce it by our $500,000 business loss, we still have taxable, or AGI in this case, of $200,000. And we've also generated a $300,000 NOL carry forward thanks to the excess business loss limitation. So in 2016, with these facts, we had an NOL carryover and no tax generated, but in 2018, our taxpayers got $200,000 of AGI and potentially a tax liability. Rolling forward to 2019, $750 of investment income reduced by our business loss. Once again, our business loss is limited. Our $650,000 loss, only $500,000 is allowable, so we got to add back $150 of it. Then we have our NOL carry forward. So in 2018, we generated this $300,000 excess business loss carrying forward as an NOL. That's limited to 80% of taxable income. So if we took our $750, reduced it by our business loss that's allowable of $500, we have $250 of income. We're allowed 80% of that, or $200,000. So over a $300,000 NOL, we can deduct $200,000 of it, and we're left with $50,000 of income. So once again, under the new law, this taxpayer has got taxable income in this scenario when under old law, they did not have taxable income in either year. So this is pretty easy to see how this can hurt a taxpayer.
And here's our second polling question. Do you own commercial or residential real estate? Commercial, residential, or none of the above? We're going to give it a few more seconds as the polls are still coming in. All right, going to go ahead and close the poll. And it looks like 31% commercial, 39% residential, and 31% none of the above.
All right, good split. All right, so on to one of my favorite of the new code sections and tax law items, Section 199, Qualified Business Income Deduction. So we're going to spend a decent portion of our presentation today talking about QBI, since there are many intricacies that affect the real estate industry. Additionally, proposed regulations were issued back in August that provide a great deal of clarity regarding the deduction. However, along with the regulations came a whole new set of questions for taxpayers. Now, it's rumored, hearing through the grapevine here, but we might have final regulations by year end. But anytime you hear a rumor with the IRS acting quickly, I'd think twice about that. So that's the word, but we'll see if it actually happens. Maybe we get a nice Christmas present, maybe we don't. We got one last year, so.
Only a few weeks left.
Yeah. So regardless of when they're issued, I'm very interested to see how the final regulations handle some of our most important questions. So the basics of the QBI deduction and why do we have it? Well, under pre-2018 law, with a C corporation, you had double taxation, 35% on the corporation plus a dividend back out to the shareholder. So the combined tax rate, assuming maximum rates, was around 50%. And also under pre-tax or pre-2018 law, if you're a flow-through entity, either at Schedule C, S partnership, you had a federal rate of 39.6, and that was pretty much it. So you had almost or a little greater than a 10% benefit of being a flow-through, provided you're distributing all the income every year. Now, under the new tax law, C corporations are given a lower 21% corporate rate, which brought the combined tax between corporate and individual level to 39.8, just barely above partnership or other flow-through type. So to preserve the competitive advantage that flow-throughs had, Congress gave us the 20% deduction to effectively reduce the non-corporate business income rate to 29.6, thus keeping roughly a 10% advantage over C corporations. The 20%, or the calculation of the 20% deduction sounds easy from a very high level, 20% of business income, but it gets really complicated. There's a multi-step process with a lot of nuances and quirks to it. So starting at a very high level, the QBI deduction is 20% of qualified business income from a domestic business operated as either sole proprietorship, partnership, S corp, and also trust and estate are eligible for the deduction as well. Now, two additional limitations apply when income exceeds a certain threshold. First limitation is the specified service trade or business are limited in their deduction. Second, a wage and or a wage and property limitation could apply and reduce that 20% deduction. That's the first part of our calc. Second, on top of that, we add 20% of the qualified REIT dividends and PTP income. So 20% of your business income with some limitations, then 20% of your REIT and PTP income. The total of those two gets compared to 20% of the overall income of the taxpayer reduced by net capital gains. So the point of having the overall limitation is to ensure that 20% deduction is not taken against income that's already offered a preferential rate. So a quick example, in 2018, a married taxpayer has $100,000 of qualified business income, or QBI, $100,000 of net long-term capital gain, and $30,000 of itemized deductions, for a total taxable income of $170,000. A's tentative QBI deduction is $20,000, 20% of $100,000 of the qualified business income. The deduction is limited, however, to 20% of taxable income in excess of net capital gain. So taxable income of $170,000 reduced by our net capital gain of $100,000 is $70,000. 20% of that is $14,000, and thus our $20,000 tentative deduction is limited to $14,000. So like I said, that threshold is a dividing line. When you're below that, the threshold, the deduction is very easy to calculate and administer. However, when you get above that threshold or part of the phase-out area, it's quite a nightmare. And thank goodness for computers, because if we did this by hand every time, it'd be a complete nightmare. So that threshold that I keep referring to for married taxpayers is $315,000, and for all other taxpayers, it's $157,500. And there's a phase-in range. So when a married taxpayer's income is above $315,000, but below $415,000, $100,000 above that, the W-2 property and SSTB limitations phase into effect. And once you're above $415,000, if you've got revenue from a specified service business, that's completely disallowed. And if you're not a service business, the W-2 and property limitations apply in full. That's not to say you can't get a deduction when your income's over $415,000. It just means you're fully subject to the limitations that could reduce the 20% deduction. And now Sarah and I are going to try to keep our acronyms to the minimal, because it can get quite confusing with tax law. But in case we do, here's a nice little slide for you guys to refer back to. When we say QBI, we're talking about qualified business income. RPE means relevant pass-through entity, the partnership or S corp or Schedule C generating the income. SSTB is a specified service trade or business. T or B means trade or business. And finally, UBIA, that one we might use, because saying unadjusted basis immediately after acquisition gets really old really fast. So UBIA we'll probably use, but we'll try to keep everything else to a minimum. All right, now this section is really good for real estate businesses. So in order for an activity to be eligible for the QBI deduction, it must first rise to the level of a trade or business under Section 162 of the Code, which is all good except for the fact that a trade or business is not really defined in the Code or the regulations. There are some definitions in court cases, though, mainly the Grutzinger case, which we'll talk about in a minute, provide a definition of a trade or business. And for most taxpayers, it's not tough to rise to the level of a trade or business, but it could be a problem for some real estate entities. But there is luckily one special carve-out, which is in the screen right here. If you're renting or licensing tangible property to a commonly controlled business that is a Section 162 trade or business, that rental activity automatically rises to the level of a 162 trade or business and could potentially qualify for QBI deduction. So that's one nice bit about it, but at the same time, if you're renting to a potential specified service business, the opposite happens, or the same thing happens, and your rental activity becomes a specified service business as well. So it, as it says in here, it cuts both ways. So looking at the court cases to see what rises to the level of a trade or business in relation to real estate. Well, overall, the Grutzinger case provides that a trade or business requires a taxpayer to be involved in an activity with continuity and regularity, and the primary purpose is for the generation of profit. A sporadic activity, a hobby, or an amusement diversion does not qualify. So continuity, regularity, and profit motive are the three key items there. For real estate in the past, it hasn't been a problem if you were not a trade or business, because under the law, whether you're an investment or a actual business, the income and deductions of the activity were allowable under the law. The only place it really came into play was when you had a loss on a business property. So a 1231 asset is tangible property used in a trade or business. And when you incur a loss on that for a business property, you get an ordinary tax rate deduction for that loss. But if you're an investment, it's a capital loss instead, and it gets limited to $3,000 per year. So the only time it's beneficial to be a trade or business under the old law is for losses, but now we want to be a trade or business in order to qualify for the QBI deduction. So when is a rental a trade or business? Luckily, courts have not asked for too much for a rental to be a trade or business. We'll go through a couple of different cases here to exemplify that. In Guilford, a rental of multiple properties in one entity in which the owner was not hands-on was still a trade or business. The court said if such management was a trade or business, the taxpayer was also engaged, although he acted only through an agent. So agency and hiring a management company could still qualify as a trade or business of your rental. Other good news, rental of a single commercial building was a trade or business. Court said, where the owner of depreciable property devotes it to rental purposes and exclusively to the production of income, the property is used by him in a trade or business. Better news, it keeps getting better all the time, Hazard and Stratton. In this court case, the individual rented a single family residence and it was considered a trade or business. Quoting the court again, the court has repeatedly held that the renting of improved real estate constitutes the carrying on of a trade or business, regardless of whether or not the taxpayer engaged in any other trade or business. However, if you're in a part of the country governed by the Second Circuit, the Greer court case has control there, and there's a much higher standard for a single family residence. Now the best news. In Jefferson, an attempted rental of a property was held to be a trade or business. So I believe in this one, there was the guy rented the property out, or no, he attempted to rent it. He was unsuccessful for several months and eventually sold the property, and it was still held to be a trade or business asset. Now, we went up the chain, good, better, best, and now we're kind of going down the other side with bad news. Unfortunately, in the Neal court case and revenue ruling 73-522, a triple net lease is not considered to be a trader business. The courts have said that a triple net lease is akin to owning stock, and it's more of an investment than it is a trader business. So factors to consider with your rental property to see if it's a trader business is the nature of the property, the number of tenants, the length of the leases, how was the property acquired, and level of involvement by the owner or even an agent. So what if you had multiple commercial properties through separate entities and each one was in a triple net lease? Well, unfortunately for the QBI purposes, we can't aggregate together different entities to rise to level of a trader business. This does exist with regard to real estate professionals being able to aggregate all their activities together to qualify as a real estate professional, but that's under the Section 469 regulations. Here we're stuck solely with the Section 199 Cap A regs, so we can't apply that. So it would appear that if you have a bunch of triple net leases in different companies, you're going to be in a little bit of trouble to qualify for the QBI deduction. All right, so hooray, you've risen to the level of trader business. What's next? Well, we got to determine whether the trader business is a specified service business, because once you're above that $315,000 threshold, it matters whether or not you're an SSTB. And an SSTB is any business involving performance of services in the fields of health, law, accounting, etc. There's not too much danger here for real estate taxpayers, especially when the proposed regs came out. They specifically mentioned that real estate brokers and management of real estate is not a specified service business. So that was definitely a win for us. However, we recently heard at one of the conferences that we attended that accounting services could be a tricky area. So if you've got a management company and related rental properties that are in separate tax entities, and the management company separately charges those rentals for accounting services, that could be an area of issue. You don't want accounting service revenue in your management company. So there are some de minimis rules that we'll discuss briefly to get around that, but I think generally I would probably advise to stop separately reporting or separately stating the accounting on the invoice to those related rental properties. Main point of this slide is that the trader business or the specified service trader business determination is made at the business level. It's not made at the owner's level. So it's all about whether the relevant passive entity is in that business. And also with tiered structures, you can have qualified business income filtering through several layers of partnerships or S corporations. As I mentioned briefly, there is a de minimis rule for the amount of service revenue you can have. So if your gross receipts in aggregate of your related parties are less than $25 million for the year and less than 10% of your gross receipts are attributable to a service in the disqualified field, then you're okay, your business is not tainted, and you should be eligible for the QBI deduction. So a quick example of that, I'm going to throw in those accounting service revenue, thanks to that conference we went to, so we'll take a look at that. ESCO, an S corporation, earns $20 million in 2018 from real estate management services. It also earns $2 million from separately billed accounting revenue for services when it helps the related rentals record their monthly closing entries. While the accounting work is an SSTB because it was separately charged, because the revenue is less than 10% of the total revenue, it's generally ignored and does not taint the rest of the business as an SSTB. If your gross receipts are greater than 25 million, that 10% threshold drops down to 5%. And the IRS clarified that this is intended to be a cliff rule, meaning as soon as your specified service revenue exceeds that 5 or 10% threshold, the entire business is disqualified. The only defense that we would have against that is to prove that we had two separate trades or businesses within one tax entity, which can happen. Hopefully everyone's heard of a disregarded entity. You could have a single member LLC, or with regards to an S corporation, a Q sub, or even if you don't separate the tax entities, there could just be different divisions within one business. And as long as you can prove that there are two separate trades or businesses and separate out your specified service revenue from your qualified business, you should be able to use this defense. The problem with that is the IRS hasn't given us much definition of how to determine whether there's two separate trades or businesses. All we really have at the moment, some case law, but nothing really super on point. But we do have Regulation 1446-1D, which says that in order to have two separate trades or businesses, at a minimum, you must have separate books and records for each of those businesses. The second of the rules to watch out for with service businesses is revenue amongst commonly controlled businesses. So the regulations say that an SSTB includes any business that provides 80% or more of its services or property to a commonly controlled business that is an SSTB. Common control means 50% or more ownership, and attribution through 267 applies. This kind of kills the idea of cracking. An example, straight from regulations, an LLC provides legal services to maximize its QBI benefit. The owners form partnership number 2 to own the building that will be rented entirely to the legal LLC, and partnership 3, which provides administrative services to the legal LLC. Because the partnership 2 rents all of its property to the law firm, and because partnership 3 provides all of its services to the law firm, all 3 are commonly controlled. All 3 will be treated as specified service businesses. So that really kills the idea of cracking. And if revenue between the related parties is less than 80%, it's a proportional disallowance rule. Part of the revenue would be considered from an SSTB. Planning idea, maybe you can try to make this happen, although I don't know if it's really possible or not, but A and B own a law firm, C and D own an accounting firm, A, B, C, D, and E, a fifth party, buy into a new LLC to own the building. So A and B own 49%, C and D own 49%, and E, the new investor, owns 2%. So overall, you've got an accounting people owning 49%, legal people owning 49%. There's no common ownership and therefore qualifies. So maybe you can try to get yourself to be that 2% number E person. And if the property or services are leased or are rendered to a commonly controlled C corporation, is the C corporation considered an SSTB? And this qualified business income deduction is for anybody other than C corporation, pretty much. So can a C corporation be a specified service business? The rules indicate yes, that it could be. So just because you're dealing with a related C corporation, you could have SSTB issues. And the final kind of quirky rule for service businesses is incidental. I don't really see it happening too much, but if there's common ownership between SSTB and non-SSTB, there's shared expenses, and the qualified revenue, the non-SSTB, is 5% or less, it's not considered to be a separate trade or business, and all of the revenue from that company is considered service revenue and is ineligible. And
here's our third polling question. Will you benefit from the QBI deduction? Yes, no, maybe. We'll give it a few more seconds as the polls are still coming in. All right, I'm going to go ahead and close the polls. 44% yes, 22 no, 33 maybe.
All right.
That's kind of indicative of how everything is going so far. A lot of people are really unsure whether or not it's going to benefit them, and that goes for a lot of areas of the new law. What is qualified business income? Items of gross income, deduction, gain, and loss to the extent items are effectively connected with the conduct of a trade or business within the U.S. and included or allowed in determining taxable income for the year. QBI is not non-trader business interest income, dividend income, long or short-term capital gain, income from an annuity not connected with the trader business, or income that is not effectively connected with the U.S. trader business.
Yeah, so kind of in the same line I mentioned before, you can't get the 20% deduction on an already lower tax rate. And on this list, you'll see dividend income and long-term capital gain are already afforded lower tax rates. So it makes sense that you can't get a 20% deduction on a preferential item to begin with.
QBI does also not include REIT dividends or PGP income, reasonable compensation, or guaranteed payments. Section 751, hot asset ordinary income is QBI. So as a result, any 1245 recapture would also be QBI. Section 481 adjustments relating to a business is QBI for adjustments created after 12/31/17. So any adjustments that were created in 2014, 2015 will not be included in QBI.
Yes, just for reference, those of you that aren't tax professionals, a Section 41 adjustment is when you have a change in accounting method. You're allowed a 4-year, I would say, recovery period or inclusion period for an unfavorable adjustment. So if we made a depreciation method change in 2015 that was unfavorable, we'd pick up a quarter of it over 4 years. Because that was created before 2018, that's not qualified business income. But if we made that same method change, accounting method change in 18 or going forward, that would be qualified business income.
And NOLs do not reduce QBI except for the piece of the NOL attributable to a suspended loss under the new section 461L.
So once again, gotta track our NOLs very carefully.
Previously suspended losses do reduce QBI when allowed for tax purposes for losses suspended after 12/31/17. But passive loss carryovers have no ordering rules. So what do we do there? In this example, 12/31/18, taxpayer A has $200,000 of suspended losses attributable to ESCO. 100,000 of the loss is from 17 and 100,000 is from 18. If we go to 2019, ESCO allocates taxpayer A 100,000 of taxable income. A uses 100,000 of suspended losses to reduce their income to zero. But as far as QBI, is that loss from 2017 or 2018? If it is from 2017, they have QBI of 100,000. If it's from 2018, they have no QBI. That's still an open question. Section 1231 gain. If netting ends up as a capital gain, both gains and losses are not QBI. If netting ends up as ordinary loss, both gains and losses are QBI. If netting ends up as ordinary income due to unrecaptured 1231 losses, both gains and losses are QBI. And we're going to go through a few examples here to clarify that. In the first example, A owns 50% of X and 50% of Y, which are both S corps. In 2018, X allocates $50,000 of 1231 gain. Y allocates A $40,000 of Section 1231 loss. Under netting rules, A nets the gain and loss together, resulting in a net 1231 gain of $20,000, so the gain is capital. Under the regulations, the $50,000 of 1231 gain from X is not QBI, and the $30,000 of 1231 loss is also not QBI. In the next example, A still owns 50% of X and 50% of Y. In this case, X allocates $20,000 of 1231 gain, and Y allocates $30,000 of 1231 loss. When we net the two, we get a $10,000 1231 loss, so the loss is ordinary. In this case, the $20,000 of 1231 gain is QBI, and the $30,000 of 1231 loss is also QBI. In the third example, still considering the same ownership, if X allocates $50,000 of 1231 gain and Y allocates $30,000 of 1231 loss, we net the two together and have a gain of $20,000. But A has $10,000 of unrecaptured 1231 losses from the prior 5 years. As a result, $10,000 of the gain is ordinary and $10,000 of the gain is capital. So logically, this would tell us that 50% of the $50,000 1231 gain from X is QBI and 50,000 is not, as well as 50,000 of the 50% of the 30,000 1231 loss being QBI and 50% not. Net 1231 gain is taxed as capital gain. If you have a big net 1231 gain for the year, it does not increase QBI and will shrink your overall limitation.
Right, because 1231 gain will be ultimately taxed as a capital gain. And as if you recall, the QBI deduction is limited to taxable income, or 20% of taxable income reduced by net capital gain.
So if we look at this example, ESCO allocates A 100,000 of QBI and 500,000 of net 1231 gain. This is A's only 1231 gain, and A's total taxable income is $510,000. Because the 1231 gain is not QBI, A's tentative QBI deduction is $20,000. The deduction is limited to $2,000, which is 20% of $10,000, the excess of taxable income of $510,000 over the net capital gain of $500,000. We're going to switch gears here to UBIA of qualifying property. UBIA, as Ian mentioned, is the unadjusted basis immediately after acquisition. Qualified property is tangible property subject to depreciation, held by the trade or business at the end of the tax year, used by the trade or business at any point during the tax year in the production of QBI, and the depreciable period cannot have ended before the end of the tax year. Qualified property does not include basis adjustments to partnerships and any property acquired within 60 days of the year end and disposed within 120 days unless it is used for 45 days. The meaning of unadjusted basis immediately after acquisition is the basis on the date the property is placed in service by the business, unreduced by depreciation, acquired by cost, contribution, or distribution from a corporation. For example, A acquired machinery in 2016 for $10,000 for use in the business. As of 12/31/18, the adjusted basis of the machinery is $4,000. On 1/1/19, A contributes the property to an S Corp. On A's 1040 in 2016 and 2017, the UBIA of the machinery is $10,000. On ESCO's 2019 tax return, the UBIA of the machinery is only $4,000. This is because when A contributes the machinery to ESCO under 362, ESCO takes an original basis in that machinery equal to A's basis of $4,000.
And the same would occur under partnership law as well. You get carryover basis when you contribute property into the partnership.
UBIA is not reduced by bonus or deductions under Section 179, 179B, or 179C. It's also not reduced by credits that would otherwise reduce basis. Improvements to qualified property that was already placed in service will be treated as separate property for UBIA. You also can have property net of depreciation if it's contributed in a tax-free carryover basis transaction. The depreciable period starts on the date the property is placed in service and ends on the later of 10 years or the last day of the last full year in the recovery period. For example, if S purchased machinery on 11/18/2014 that is used in the business and depreciated over 5 years, even though the depreciable period is only 5 years, the owners will be able to take the unadjusted basis of $10,000 into account for 10 years, from 2014 to 2023. If we take the same facts, but a non-residential rental depreciated over 39 years, the owners will be able to take the basis into account from 2014 to 2052, the last full year of the depreciation schedule. There's special rules for 1031 exchanges. For 1031 exchange, the date of the replacement property for the UBIA is split. Substituted basis is deemed to be placed in service on the date relinquished property was. Any excess basis is deemed to be placed in service on the date the replacement property was. For example, in 2014, ESCO acquires a building for $1 million. In 2018, when the basis of the building is $600,000, ESCO exchanges its building plus $250,000 in cash for another building in a 1031 exchange. ESCO takes a split basis in the property. For $600,000 of UBIA in the replacement property, the depreciable period begins in 2014. For the $250,000 of additional cash of UBIA in the replacement property, the depreciable period begins in 2018.
Once again, record-keeping nightmares.
There are also special rules when property is received in a so-called step-in-the-shoes transaction. The date the property was placed in service will split as well. Up to the amount of the transferor's UBIA in the property is placed in service when the transferor placed in service, an excess basis when the transferee places it in service. For example, A acquired machinery in 2016 for $10,000. As of 12/31/18, the adjusted basis is $4,000. On 1/1/19, A contributes the property into an S Corp in exchange for stock. On S's 2019 tax return, the UBIA of the machinery is only $4,000. And the depreciation period started in 2016. Allocation of UBIA is very complicated. Each partner or shareholder's share of UBIA is equal to the partner's share of tax depreciation over the total depreciation. But this does not account for the basis of property with no depreciation. From there, you have to use the 704C rules to calculate the allocation. Go to an example on the next slide. To illustrate this, A is a partner in partnership ABC. The partnership holds 4 assets, assets 1, 2, 3, and 4. The total UBIA of property 1 through 3 is $1 million. The UBIA of property 4 is $200,000. The depreciable period is still alive for all 4 properties. Property 4 has no tax depreciation, and the property was contributed by A. Assume that under 704C, if the property was sold for its fair market value, the entire gain would be allocated to A. Therefore, A's share of UBIA is 33% of the $1 million for property 1 through 3, and then 100% of the $200,000 for property 4.
Once again, record-keeping nightmare. So, for those of you who are reporting your own tax returns, or preparing your own returns, you want to pay attention to this section. Once you've spent a great deal of extra time calculating your QBI, your UBIA, allocating it, you'll need to report it on the tax returns. And failure to report these items can have dire consequences. So, what are the requirements? Well, the pass-through entity must separately identify and report on the K-1 to each of its owners any trade or business engaged in by that entity. It must report each owner's allocable share of qualified business income, W-2 wages, and UBIA limitation items. It also has to indicate whether or not the business is an SSTB. And looking at the draft K-1 for the Form 1065, Box 20Z has these items in it, so you'll be able to pretty easily see that. However, if the RPE, the pass-through entity, also has an interest in another RPE, then it has to flow through that entity's qualified business income, W-2 wage, property, and SSTB determinations. And that's not on the form. That's going to be part of a footnote. So if you've got a large tiered structure, you're going to have a pretty large footnote on the back of the K-1. Additionally, also because the REIT dividends and PTP income are included as part of the QBI deduction, those are also reported on the K-1s. Now, there's consequences of not reporting. If you read the strict wording of the proposed regulations, they say that the positive QBI, W-2 wages, and UBIA of qualifying property is presumed to be 0 if all the filing requirements for each trade or business are not met. So what does that mean? It seems as if there's a negative QBI, so a loss in activity, that still is allowed. So that's a way to prevent taxpayers from increasing their QBI deduction artificially by removing unwanted losses. But the key item here is we just talked about how hard it is to calculate these UBIA property and how to allocate them. And if you don't report it correctly, the whole deduction gets disallowed for that activity. So if you've got maybe like the management company where you have W-2 wages, you still have to report UBIA of qualified property on the K-1, because if not, the strict interpretation of the law says the entire QBI amount is going to be disallowed. So you've got to be very careful with your reporting. And with that, we'll go to polling question number 4.
Do you think a technical corrections bill will be passed? A, no, it won't get through the House. B, no, the Senate won't pass it. C, no, neither will agree on anything ever again. D, yes, I'm optimistic.
Yeah, so we've already heard of Tax Reform 2.0, and not much has come out of that. And now there's a technical corrections bill that's been proposed, but with the gridlock we see down in DC, I'm not very convinced we're going to get much, but don't let my pessimism influence you. You can answer to your free will. It is a free country.
All right, with that, we're going to go ahead and close the poll. And 13% no, won't get through the House. 11% no, the Senate won't pass it. 34% no, neither will agree on anything ever again. And 43% are optimistic.
Wow.
That's surprising. I got to hang out with those people more often.
Hope so. Aggregation. So as a general rule, the 199A deduction is determined separate for each trade or business using separate calculations of wages and UBIA, but proposed regs provide for an aggregation regime that can be elected. The election can be made by individuals, trusts, and estates. It's important to note that trusts and estates can only aggregate if they are the ones taking the QBI deduction. To aggregate, the businesses must be under common control. Common control is when the same person or persons own 50% or more of the capital profits interest, issued outstanding stock, and individuals are considered owning the interest in each trade or business directly or indirectly by their spouse, children, grandchildren, and parents. Here's an example of aggregation. F, S, and M own various percentages in S1, LLC1, and LLC2. Since they are father, son, and mother, they are treated as owning what each other owns. Combined, they are treated as controlling S1, LLC1, and LLC2. If the other tests are met, they may aggregate some or all of these businesses. Control must exist for a majority of the tax year. Businesses must also be on the same tax year, and you cannot aggregate with a specified service, trade, or business.
Yeah, that second bullet point there has been providing me personally with a bit of doubt. The wording of the regulation is a little unclear on whether it's the tax year must be the same between the owner or the ultimate person reporting it, or if it's the tax year of the two relevant pass-through entities. And also with the majority of the tax year, that's almost the exact wording from the reg, majority. Usually tax law is a little more specific and it says 183 days or more, but which we can assume is the case, but like I said, the regs are kind of bland and just use the word majority.
In order to aggregate, all of the businesses must satisfy two of the three factors. Must provide products and services that are the same or customarily offered together, share facilities or significant centralized business elements, and operated in coordination with or reliance upon one or more businesses in the group. As an example, D owns 75% of the stock of S1, S2, and S3. Each S Corp operates a grocery store in a separate state. S1 and S2 share centralized purchasing and accounting offices. S3 is operated independently. Even though S1, S2, and S3 are commonly controlled, only S1 and S2 satisfy two of the three factors to qualify for aggregation, and as a result, S3 would have to stand on its own. A second example, A, B, C, and D each own 25% of two businesses, a restaurant and a catering business. They share a kitchen, purchasing, and accounting office that performs all accounting functions for the businesses. Even though none of A, B, C, and D own 50% directly, because the same group of taxpayers control 50% or more of both businesses, any of A, B, C, and D may aggregate the two businesses if the other tests are met. And the two do meet two of the three factors. Both offer prepared food to customers, and they share facilities and centralized business elements. So in that case, A, B, C, and D may aggregate as they choose. To be considered for aggregation, an activity must rise to the level of a Section 162 trade or business. However, proposed regs provide that an activity that rents or provides services to a commonly controlled trade or business qualifies and may be aggregated.
And just remember that it may be aggregated just because, this is what I mentioned earlier, that just because you rise to what level of trade or business does not necessarily mean you automatically qualify for aggregation. You still have to meet the other tests.
In this example, D owns 100% of S1 and S Corp, which is a trade or business, and 100% of P1, which is an LLC. S1 leases a building from P1 on a triple net lease basis. Because they are commonly controlled, P1 automatically rises to the level of a trade or business. So remember, an activity cannot be aggregated unless it satisfies the trade or business standard. If aggregation is elected, the taxpayer determines the 199A deduction for the aggregated business by using the combined QBI, wage, and UBIA. Owners of relevant pass-through entities can aggregate differently. So long as there is a group that owns 50% or more, a minority owner involved in those entities may also aggregate. H, J, K, and L own 30, 25, and 45% respectively of 2 partnerships and 2 S-corps, and each business satisfies 2 of the 3 factors. Once they meet the test, the partners and shareholders are free to make their own decisions as to how to aggregate their interests. For example, H aggregates P1 and S1 together and P2 and S2 together, whereas L aggregates S1, S2, and P2 and leaves P1 alone. All 4 aggregations in this example shown are appropriate, so they can choose however they'd like. A minority owner in a situation where 3 businesses are owned 99% by taxpayer A and 1% by taxpayer B that meets the other requirements may also aggregate. So just to be clear, that means that the owner that owns 1% is not precluded from aggregating just because they're a minority owner. They can aggregate their 1% interest so long as the group combines to own 50% or more of the 3 businesses. The election to aggregate is made at the individual level. Once you aggregate, you must continue to do so. You can add newly acquired or formed entities to the aggregation, but you cannot remove unless you no longer meet common control or no longer satisfy 2 of the 3 factors. So that's important to keep in mind, that you can't just pick and choose which you want to aggregate together each year. Once you do so, you have to actually be disqualified to remove a trade or business from your aggregation. So you want to be sure that and aware that this is on a go-forward basis, and you're not going to just be able to exclude one in the next year.
Yeah, once again, with these permanent elections, you got to think a couple of years down the road. Don't just look at the current situation. Think about the long term.
So disclosures. For each year, a statement must be attached describing the name, EIN, and business they're aggregating. You must identify any entities that are new or disposed of. And there's an open question here. Are relevant pass-through entities required to inform minority owners about common control by others? We don't know.
Yeah, because it's really tough. Should you be required to report information? That could be useful, but certainly you might be disclosing too much about people. So I doubt that's a bit of discretion on the accountant and the owners of each company to figure out what exactly they want to do. But it does not appear as if there's a requirement to do so.
In the next example, E owns 60% of P1, P2, P3, and P4. Each partnership meets the requirements to be aggregated. E would like to leave P4 on its own and aggregate P1, P2, and P3. So just to reiterate, there's no requirement that a taxpayer aggregates all businesses that are eligible. It's not an all or nothing election. So in this case, they have 4 partnerships that can be aggregated. They chose to aggregate 3, and that is fine. If he chooses not to aggregate one of the 4 in year 1, he can't in year 2 add it unless it was newly formed or newly owned by him. So keep that in mind. And
here's our 5th polling question. How much extra time are you budgeting to deal with the tax law changes per return? 15 minutes, 30 minutes, 45 minutes, 1 hour, or none? We're already experts.
If anyone answers, we're already experts. Can I please talk to you?
10% already answered. We're already experts. We're going to give it a few more seconds if the polls are still coming in.
I think it's going to be hard to estimate how much extra time it's going to add, but I would assume it's probably more than 0 at this point.
Yeah, I've heard rumors that some of the big 4 accounting firms are budgeting an extra half hour per K1 just because of all these different disclosures and whatnot.
Wow.
So a lot of time. So
we're going to go ahead and close this.
In defense of your accountant, we have a lot of extra work to do. So if your bill's a little higher this year, you can see why, because there's a lot of stuff for us to work through.
All right, 9% at 15 minutes, 18% 30 minutes, 4% 45 minutes, 60% at an hour, and 9 we're already experts.
Love it. All right. So the final section to bring us home today will be discussion of qualified opportunity zones. So the purpose of the opportunity zones is to encourage long-term investment in low-income urban and rural communities across the country. According to one group, more than $6 trillion of unrealized capital gains is sitting idle with individuals at the end of 2017. The idea behind the opportunity zone is to get some of the unrealized capital gain off the sidelines and into those low-income communities that have need for that capital. Here's a quick map from the EIG that indicates, where the 7,800 opportunity zones are across the country. So roughly 10% of the U.S. population lives in an opportunity zone, and on average, the poverty rate in these zones is 30%, which is much higher than the national average of 12.3. And if you want to look through this map a little bit, I include the link in the webinar. So some basic rules. To invest in an opportunity zone, you first must invest in something called a Qualified Opportunity Fund, or QOF. QOF, it can be a partnership or a corporation set up for purposes of investing in a qualified opportunity zone property. The QOF will then invest in the qualified opportunity zone property. So you invest in the fund invests in property. And what are the benefits? Well, there's a couple. First, deferral of the original capital gain. If you reinvest capital gain amount into the qualified fund within 180 days of incurring the gain, you can defer paying the tax until the later of the date you sell your interest in the fund or the end of 2016. And please note that you must invest the gain, not the entire amount of the proceeds, just the gain. So your original basis can be kept in whatever you want to do with it. That's one key differentiation between this and a like-kind exchange of a 1031, where all the proceeds must go to the new investment. With a QOF, only the gain portion has to be reinvested. Other benefits, if you hold the property or your investment in the property for 5 years, 10% of your original gain gets taken off the table. If you hold it for 2 years beyond that, another 5% comes off. So if you hold the property or your investment for at least 7 years, then 15% of your gain gets taken off the table, which is nice. Finally, and probably the biggest incentive, if you hold your investment in the fund for 10 years and you deferred your original capital gain, you can exclude the full amount of gain that you have from the QOF investment. So that's not you can't exclude the original gain. It's the gain on the QOF investment in the fund. Because, as I stated earlier in the first rule, on 12/31/2016, you're going to pay the tax on hopefully only 85% of your original capital gain. That's when the deferral ends. So only capital gains are allowed to be deferred, not ordinary gains. Capital gains do not need to be of like kind, meaning you can sell stock and use the proceeds to invest in real estate opportunity zone. So, like kind exchange has to be similar property. In this, you can use stock gains to invest in real estate. That goes without saying, depreciation recapture in a 1245 is not eligible because that's not a capital gain. And those taxpayers that are eligible to roll their capital gain into a qualified opportunity zone investment include individuals, C corps, partnerships, S corps, trust estates, and certain other pass-through entities. So the proposed regulations that came out provide that for the first day of the 180-day period is the date in which the gain will be recognized for federal income tax purposes. So you have 180 days from that gain to reinvest it. A stock trade or capital gain dividend received will be recognized on the date the stock is traded or the dividend is paid. Now, if you're getting your capital gain from a partnership, there's special rules at play. So if the deferral election is made by a partnership, no part of the deferred gain is required to be included in the distributive shares of the partners. However, if the partnership does not make the deferral election, each individual partner has 180 days from the last day of the tax year of the partnership. Because thinking about the reporting of it, a lot of times partners don't know what's happening in the partnership, especially if they're a limited partner, until they get their K-1 from the tax return, or at least an estimate for their extension purposes. So it'd be unfair if the partnership sold property midway through 2018 to generate the capital gain, and only 3 months or 180 days later, end of the year, expires and the individual hasn't heard from that partnership yet. It wouldn't be fair to them. So there's a special rule in the case of partnerships. The partners have an extra time for that 180-day period to run. So an example to hopefully make that a little more clear, partnership A is a calendar year taxpayer, has 2 equal partners, and incurs $200,000 capital gain on January 31st, 2019. If the partnership A decides not to elect to defer the capital gain, each partner will have the opportunity until June 30th, 2020, 180 days after the partnership's taxable year end, to roll their respective $100,000 capital gain into an opportunity zone investment. To hopefully make things a little more clear, a nice timeline, let's assume in December of 2018, an individual sells stock for a $200,000 gain. On March 1st, 2019, within the 180-day period, they roll the $200,000 capital gain into a QOF. On March 1st, 2024, 5 years later, 10% of that gain is taken off the table. March 1st, 2026, 7 years after the original investment, another 5% of the gain gets taken off the table. Then on December 31st, 2016, the gain becomes recognized for taxable purposes. However, we excluded 15% of it, so only $170,000 worth of the gain becomes taxable. Finally, 10 years after our investment, March 1st, 2029, the property is sold, or the investment is sold, and there's no gain on that part because the 10-year period is run. So in 2032, the QF investment is sold for $500,000, and no part of the $300,000 gain is subject to tax. Now, with QO opportunity zones, there's a lot of caveats, and one of which is the whole idea that the capital gain is going to a low-income area to improve it and for it to be reinvested. So going along with the spirit of the law, the code and regs state that the qualified opportunity zone property held by a qualified opportunity fund must satisfy one of the following requirements. The original use of the qualified zone property commences with the fund, or the qualified opportunity zone fund substantially improves the property. So you've got to be improving the area either through new buildings or substantially improving property that was already there. What is substantial improvement? Well, it means that the taxpayer must double their adjusted basis in the property after purchase during any 30-month period that they hold their qualified opportunity zone property. The additions to basis must exceed the adjusted basis of the property at the beginning of such 30-month period, and land is excluded. So you're really looking at the building must double, not just the land. So we're running out a bit of time here, so I want to skip a few of these slides, and we'll move on to the funds themselves. So opportunities or investments go through the funds, which I said could be a partnership or a corporation. The fund can self-certify itself as a qualified opportunity fund. And a taxpayer must have an equity interest issued to the issued by the QOF to qualify as an eligible interest. Obtaining an interest through debt is not permitted. There's a couple of percentage rules to discuss here. The first is the 90% rule. A QOF must hold at least 90% of its assets in a qualified opportunity zone property. So there's the QOZ property and the QOZ fund. Qualified opportunity zone property is property which is QO zone stock, QO zone property interest, or QO zone business property. Compliance with the 90% asset test is determined by the percentage of qualified opportunity zone property held in the QOF, measured twice annually. So an example, a group of taxpayers roll their capital gains into a QOF with the intent to buy an office building in the zone. They create the fund, and within 180 days of creation, they purchase the office building with plans to redevelop it. If they roll the $1 million of capital gains, they would need to have at least $900,000 tied up in opportunity zone business property, which the office building they can purchase, and only $10,000 can be held in cash. So easy way to see that, you have investors with $1 million go into the fund, $100,000 in the fund can stay in cash, $900,000 has to go to the building. So as you can see, there's only 10% being held in cash. If you're trying to improve the property, you're going to need cash to spend. So that can be a tough problem. There is something such as a safe harbor for 31 months to improve that. And as we're running out of time still, I'm going to pass through some of these pretty quickly. But I like this slide because the graphic on the right. So the fund invests in business or qualified opportunity zone business, which then in turn invests in real estate in the opportunity zone. That's the basic structure of how this works. There's a bunch more rules, a 70% test for the opportunity zone business. To show a quick example of that, assume you have $1 million invested into the fund, 90% must go into the partnership owned by the fund, 10% can stay in cash, and that partnership invests into the actual property, and 70% of that partnership investment must be into the further property, and you can keep 30% in other assets. So ultimately, only $630,000 is actually in a property, and you've got $370,000 in other assets. So using the rules and tiered structures, you can get more than just $10,000 of cash within this opportunity fund.
And here is our sixth polling question. What is the area of the TCJA that you feel will cause you the most stress this coming busy season? Determining SSTBs, QBI calculations, UBIA, interest limitation, losing the tax prep fee on Schedule A. All right, we're going to go ahead and close the poll. And it looks like 60% said the QBI calculations, 24 interest limitation, and the other two fairly spread across evenly.
All right. In the interest of time, we have to skip over the final couple of slides. We did include them, if you feel like reading through them yourself, talking about the 31-month safe harbor for working capital, a way to get more cash into the fund. And also, last thing I want to mention quickly, the second bullet point here, the taxpayer does not have to sell the qualified their interest in the QOF right at 10 years. They can hold it for a long time. However, they have to sell it before 2047 ends in order to receive the zero gain on the sale. So with that, let's know if there's any questions.
We did have a few questions come in, and since we ran out of time, we will email the questions on over to you guys. Also, if you have any additional questions, you could add them into the evaluation form that will pop up as soon as you exit the webinar.
And since we did go a little long and cut off part of the QOZ stuff, WITHM is considering doing a separate webinar on qualified opportunity funds. So if you're interested in that, make sure you put a comment in the evaluation for us to let us know that you want to hear from us on that.
Thank you and have a great day.